Good afternoon. My name is John Quigley. I am the president and CEO of the Elmhurst Chamber of Commerce and Industry. It was 22 years ago that Larry Forsberg called me and said, Carl Tannenbaum lives in Westmont and wants to do a program. Would you be interested in partnering with us? We jumped into that, and 22 years later, we're doing a great program, and we have 20 different chambers participating with us. This also may be my last running the Chamber of Commerce in Elmhurst, but I did want to give special recognition to Larry and his staff for pulling this all together. Give them a great round of applause. Good, they switched before I said to my immediate right. But to my immediate right, Dr. Joe Cassidy is the Assistant Provost for Workforce and Economic Development at the College of DuPage, an intrapreneur focused on agile and responsive program development. He has launched dozens of short-term career training programs and hundreds of courses, resulting in a 50% enrollment growth in enrichment and workforce programs at COD. Cassidy also is the chair and founder of Innovation DuPage, the Western Suburbs' preeminent business incubator based in downtown Glen Ellen, and he serves as treasurer of WorkNet DuPage and a trustee for Choose DuPage, the economic development arm for the County of DuPage. Please welcome Dr. Joe Cassidy. Since 2009, a highly regarded economist from the Federal Reserve Bank of Chicago has presented their expert financial insights to hundreds of business people representing chambers across DuPage County. Today, we're blessed to have with us the Chicago Fed's leader and president and CEO, Austin D. Goolsbee. In his leadership role, Goolsbee serves on the Federal Open Market Committee, the Federal Reserve System's monetary policymaking body, and oversees the Chicago Fed's broad scope of activities, which includes conducting research and monitoring local economic conditions in support of the formalization of monetary policy, supervising and regulating banking organizations, and providing financial services to banks and similar institutions, as well as to the United States government. Prior to becoming Chicago Fed president at the start of 2023, Goolsbee served as the Robert P. Gwynn Professor of Economics at the University of Chicago Booth School of Business, where he first joined the faculty back in 1995. Goolsbee served as a member and then chair of the Council of Economic Advisors from 2009 to 2011 and was a member of President Obama's cabinet. Would you welcome Austin Goolsbee? Joe, take it away.
Thank you so much, John. Thank you, Larry, in the Westmont Chamber and all of the chambers. Thank you to the business owners, to the nonprofit leaders in the room, the business leaders. Thank you for all you do to keep Chicagoland, Greater Chicagoland, so dynamic. And then, of course, thank you for being here to our distinguished guest, Dr. Austin Goolsbee. We've had some questions already received from across the chamber, so we want to dive right in, if that's okay.
Okay.
Perfect.
You failed to note that the 10 days of spring have begun.
Yes, welcome to spring. Yeah. We should have 4 inches of snow by the time you leave. So 2023 was a period of significant economic adjustments. The 12-month inflation rate came down considerably from 5.5% to about 2.5%, yet the unemployment rate was quite low at about 3.7% at the end of the year. How do you explain these numbers?
Okay, there's a lot, that was a trick question, but there's a lot behind that. I was saying the normal trade-off that economists see is if you want to get rid of inflation, you got to have a big recession. And historically, that was always true. As we went through 2023, I started calling it the golden path, that maybe we could get the inflation down without having a big recession, because there were several weird things about 2023 that were not like normal. So if your thing was to just look back at history, and then you would have concluded it's impossible, but we had COVID, a destruction of the supply chain, a bunch of damage that was healing. The supply side improvements that we saw in 23, I think were central to enabling that to happen. Kind of begs the question, well, then can they continue in 24? I hope so, but it's not going to be as extreme as it'd be the golden tributary, not the golden path or something, but I think that mostly explains how they could happen.
So we'll come back to the golden path perhaps a little bit later. Sticking with unemployment, it's ticking up slightly.
Yeah.
We're up to about 3.9%, I think 3.5% in Greater DuPage. I wonder if you might say more about the trends in the labor market, both regionally and nationally. Feel free to touch on any of the things that are affecting this, like that are employers' minds, like working remote and AI, aging
Right.
population.
Well, look, who am I? I'm not going to tell 20 chambers what the economic conditions are like. We should just open up and you could tell me. A big part of our thing at the Chicago Fed is talking to the region and local business to get some more color. I would say, what a bizarro universe it was, the labor market from 2020 up until last year. Labor shortages like we've never seen, the work from home dynamic, total scarcity, obviously not in equilibrium, not sustainable. It feels to me like we're getting a little more into balance in the labor market setting. Still a strong labor market, as you say. There has been for many years a view among economists that full employment was 4%. Some people thought even higher unemployment than 4%, that you really couldn't get unemployment below that. So it's inched up, but it's still at a very strong rate. But the data measures we typically look at, like the ratio of job vacancies to the number of unemployed workers, or the voluntary quit rate of people who are in jobs now, things like that. We went from unprecedentedly tight labor market to something more like a regular boom. So it kind of feels like we're getting back to something like good normal.
A little more regular.
Yeah.
Okay, great, thank you. So we've had a couple of months of higher inflation numbers. We just received February reading on the PCE, the personal consumption expenditures, which I think the Fed prefers over PCI.
Yes.
What caught your attention in this recent report, and how do these data sets influence your thinking about progress on inflation?
Okay, again, there's a lot of deep in that question. Let's back up. You see the CPI. You understand the CPI, they have a basket that they say the typical American buys XYZ stuff, and they go out and they literally have thousands of price trackers who go to the store and check the prices of that basket. That's where CPI comes from. That's not what the Fed looks at. Somebody's calling, they're like, that is what we look at. No, but we look at the personal consumption expenditure, which is just a different measure of inflation. If you really want to get into it, we can go in it. It includes more things. It's a more accurate measure. And we look at core inflation, which means we take out food and energy prices, which then stop. My mom is furious. What do you mean you don't look at food and energy inflation? That's all I look at. We don't look at that as a measure of how things are doing because they're very volatile. So they're not that predictive of what's the true state of things. If you look at core inflation, it got out of control. There's a target that the Fed sets to get inflation to 2% and to keep it at 2%. Congress gives us by law a mandate of what our job is at the Fed, which is stabilize prices and maximize employment. So we've said publicly we want to get PCE inflation to 2%, and it got almost to 6% and out of control. We've worked it back, and taking a longer arc, it's clear inflation is way down from its peak. We have hit a little bit there. That was not without bumps, and you highlight January, February, there were some bumps. The February bump was smaller than the January, so that's at least good. But I always say 1 month is no months, and 2 months, that's a real month. So that we had that for 2 months, you can't just dismiss it as noise. I still feel like if you look at the broader economy, it doesn't really look like broad-based overheating. Those labor market metrics are coming back into better balance. There are even some things that are a little cautionary, like if you look at consumer delinquencies, they're rising, and in the past, rising consumer delinquencies have been an indicator that the business cycle is kind of turning. So it doesn't feel like broad overheating, so I still think if you take a longer arc, inflation's coming down, and we're going to get to 2%.
Thank you. So you mentioned core inflation, and again, excluding food and energy, those volatile areas.
Yeah.
Anything we should be thinking about differently with the three core components of goods, housing, and then services excluding housing? Anything we should be looking at?
I love the attention to detail on this. If you love looking at price indices, I'm going to give you what to look at. Within this price index of core price index, there's 3 parts. There's goods, there's services, there's housing. The first thing to remember is 2%. We basically were at 2% before COVID. And that doesn't come about from everything in the economy having an inflation rate of 2%. They were very different rates. Services were about 2.5% a year. Housing was like 3.5% a year, and goods were minus 1% a year because there's productivity growth, the price of physical goods getting cheaper and cheaper. Combined, those were where the 2% came from. What happened in COVID is everything went crazy, and the improvement in 2023 was dominated by goods coming back to minus 1% a year. And a lot of that came from the supply chain healing. That got up 9 or even higher percent a year at its worst. That was a big improvement. Services, you've seen some substantial improvement, though it's still got a ways to go. The biggest puzzle, and what I highlight to everybody to watch, is the housing part. Housing inflation is down a little from its peak, but it's still way above what it was pre-COVID. It was 3.5. It's 5.5, 6% continued now, even as overall inflation's come down. That's important, and it's puzzling because we know how the number is calculated. And if you go look at, say, market rents, the inflation, market-based measures of inflation are down, but the official numbers haven't come down the way that we kind of predicted they were. So I've been personally watching that housing. It has to come down. I still think it will, and as it does so, it gives us, not breathing room, but it gives us a little momentum to keep getting down to 2%. But if it doesn't, that's a threat to our target.
Okay. You mentioned pre-COVID a couple times.
Yeah.
As inflation starts, getting closer to 2% on average across those 3 components, do we return to pre-pandemic norms in pricing?
Pre-pandemic norms in pricing. Let's just distinguish the inflation rate from the price level. The inflation rate, of course, is how much do prices go up in a year. And it's never zero, and it's never negative for the economy as a whole. It's a matter of degree. So our explicit goal, as given to us by the Federal Reserve Act, is to stabilize prices, which we've interpreted as 2% inflation, but it's not going back to the price level of 2019, 2014. But my grandpa used to always have it, when I was a kid, going to the movies cost a nickel. You know, movies are not going to be a nickel. We're not, to get back to the level that prices were before COVID, you have to have substantial deflation. And I'll just remind you, the only times you have deflation are like the Great Depression, the financial crisis, the lost decade in Japan. The deflation is not a fun experience. So our goal is not to tank the economy while stabilizing the prices, and to get incomes up. If the prices are up some amount, we want our incomes to go up more than the prices were up. And for a couple of years in there, that was not happening. And you can see it in people's dissatisfaction. Now they are growing faster, and that's where we want it to be.
And you mentioned income growth, and I hear people discussing wage growth. Has it been too high to be consistent with the Fed's 2% inflation target? So what do you think of that, and what wage growth is consistent with the target 2%? Okay,
you can't answer that question. What wage growth does it need to be to match 2% without knowing something about productivity growth? Okay, so if we get better, technology advances, and we have more output per worker, per hour, per whatever, then wages can't go up without inflation. We can have economic growth. And what you've seen in the last year is actually productivity growth has been much stronger even than the pre-COVID trend, and especially compared to the beginning of COVID years. If that continues, that might not continue, we might just get back on the trend, but if that does continue, then it's more like if you're old enough, you'll remember the late 90s was a period where productivity growth started getting much higher than trend, and that has implications, lovely implications for wages, GDP, monetary policy, etc. The only other thing I'll say about this is, if you look historically, wage growth is not a very good leading indicator of price inflation. Prices tend to move faster than wages move. So when things happen, first the prices go up, then the wages go up, then the prices come down, then the wages come down. So if you had in your mind, the Fed should just keep stomping the brake until wages come down to match something like 2% inflation. You just want to be a little careful that you're not overshooting.
Okay, thank you. You mentioned, you alluded to the dual mandate.
Yes.
How do you go about, I'm sure this is a simple answer, how do you go about balancing the dual mandate of holding inflation to 2% and full employment?
The dual mandate is the thing I said, stabilize prices and maximize employment. Sometimes those are in contradiction and there's a trade-off. In 2023, there wasn't a trade-off, and that was the puzzle. There was kind of a traditional view, which was, no, we know there's a trade-off, therefore inflation's too high and you'll never be able to do it unless you crush the economy. And you had very prominent economists like Larry Summers saying unemployment will have to go to 6% for 5 straight years before you will see inflation come down. And he was basing that on the historical. The short version of the answer to the question, how do you balance that, is you gotta take into account the totality, what all the conditions are. So it was important in 2023 that we not overreact to just seeing that GDP growth was strong and the jobs numbers were strong did not mean, we better keep tightening until we see a recession, because there were these other things that made the year quite different from the historical experience. that's harder as we go into 24 and 25. It probably gets to be more like the traditional lessons are the ones applying. So we'll just have to play by ear on that.
So turning to rates, interest rates. With inflation coming down, the next step would seem to be reduction in the interest rate. And if I understand it correctly, the Fed it controls the federal funds rate. The FOMC has said it's waiting for greater confidence that inflation is indeed on track to return to 2%.
Yes.
What would give you that confidence? And once you begin, how quickly do you expect to cut rates?
I'm always supposed to say, and I should have started with it, I do not speak for anyone else on the committee. My views are only my own. That's a great relief to them and, and to me. So what I look at to have confidence, I told you, in the immediate term, is this housing inflation. I think we've had, if you take the 9-month span, we've had great progress on inflation, and that is a path that looks like it's headed to 2%. And I think there is room to get us there if we start to see housing inflation coming back to something like more normal conditions, the way we've already seen for goods and partly seen for services. That said, I think it's worth noting the Fed funds rate is basically like short interest rates. That's what the Fed controls or has a strong influence on. The level of tightness, if you approximate it by what's that short interest rate minus what's the inflation rate, that kind of real federal funds rate we call it, as a measure of tightness, it hasn't been this high in a very long time. Okay, so that interest rate is over 5 and the inflation rate is down in the 2s. Okay, so a real rate that big, I think implies this is pretty restrictive. This is pretty tight. And if you think conditions are getting back to normal, then the question is, well, how long do you want to stay restrictive or do you want to normalize it? That leads to its own religious war among economists of, well, what is they call it the R star. What will we settle back down to? I don't want to get involved in that war. I want to look in the immediate term and let's manage this thing point to point. We want to be more convinced that we are on path to 2%. For me personally, I think that says watch the price data, not the employment, GDP growth, et cetera, because we're in a weird moment. In the old days, you could just look at the GDP growth and be like, GDP growth is too high. We've got to be in a more stabilized, balanced approach. I basically reject that. I don't like thinking, ooh, people are earning too much money. The GDP is growing too fast. I think this is a moment where that logic is the wrong way to think about it. The thing to watch is inflation, and especially this housing part. If we start to see progress on that, I'm going to have more confidence.
Okay, thank you. So the U.S. economy has faced many challenges over the past few years. Of course, COVID, to put it lightly, right?
Right.
Supply chain disruption, inflation, labor shortages, a number of these things you've already mentioned. War, high gas prices. There's quite an extensive list.
Yeah.
What are you focused on right now, both domestically and abroad? What are you watching and saying, hey, I'm concerned about whatever it is?
I often say the job of central banker is to worry about everything. What keeps you up at night. Your job is not to sleep. You're supposed to be up at night, worrying about everything there is. That same list, I would carry most of those over to page 2. So external shocks in our language have derailed soft landings that were easier than this one before. If you go back and look, if war escalated and drove up the price of oil, we know what happens if the price of oil goes through the roof. If war in Ukraine extends and our major trading partners get into a pickle, that would affect us. If there were meltdown in China, though it's not that large as a direct input into the U.S. economy, I don't see how the second biggest economy in the world could really go into steep decline without everybody feeling that, and there'd be a little bit of a business freak out channel. And this persistence of inflation and what's happening with housing, but overall, if inflation stays persistent and we started to see more deterioration of the labor market, that's a stagflation-y seeming scenario that's never comfortable for the central bank. So right now, that's in my choice set of, let's call them the top 5 risks, but I gotta keep an eye on at least 20.
I have a quote here, and I think you almost said it exactly again. I've heard you say.
But it was me? It was a quote from me
it
or
was a quote
someone
from
else?
you, but it was that the role of a central banker is to be paranoid.
Oh,
But,
okay.
but with that
Okay.
said,
That could have gone way worse.
I think I heard you say something along those lines.
No, that's what I mean.
Yes.
That's the same.
But given that, what are you looking at that's really positive?
Oh, what's
In
really
our current
positive?
situation.
Okay, I like that. Yeah,
You're welcome.
Strongest part of the economy right now, is the job market and consumer spending. Those have been remarkably robust, super strong, went through at the end of 2022. You'll remember, they had a survey reported in the Wall Street Journal, 100% of economists agreed that there would be a recession in 2023, okay? There wasn't. Not only growth was actually faster than trend. It was a pretty good year, strictly by the numbers. And the main thing that drove that was the consumer proved stronger and more resilient than people gave them credit for. And the job market was a key part of that. Wage growth was quite robust. And as we go into 2024, it's not a bad place to be. What we've seen has been stable, and so I still think consumer plus job market, that's the strongest thing going.
And I think you've probably started to answer this, if not answered it fully, but I heard a story that you told on Odd Lots, a great podcast, about the limits.
This guy's really doing your homework here. What this? Okay, so on Odd Lots, what was the story?
The story was you were talking about the limits of predicting the future based upon past trends.
Yes.
And you gave the example of your grandfather telling you, do not invest in the stock market.
Right.
Because he lived through the great crash.
Yes.
And so you brought that up as a way to say this is a really odd time in that all the traditional signals are not necessarily playing out. I think you say it sounds like we're starting to get into where it will be more tied. But is there anything else that really stands out that's so non-traditional right now that you would caution us not to look at those normal trends?
Yeah, this is an important question. When I told the story, I did tell it funnier.
You did.
Than it
I'm
was,
not that funny.
Portrayed. One that I'm still keeping an eye on that's really, really different, and it's worth just emphasizing how different it is. Normally, the Fed controls the interest rate. And so, of course, our impact is on the interest rate sensitive parts of the economy. It's kind of like you hired the handyman, but he has only one tool, which is a screwdriver. We can tighten or we can loosen. If it's anything besides needing tightening or loosening, we're kind of at a disadvantage. It was like, can you make dinner with a screwdriver? Not really, and normally it works okay because the most interest rate sensitive parts of the economy are also the most cyclically sensitive parts of the economy. So it's like, if the economy's booming, it's usually durable goods and construction and a bunch of interest rate sensitive things are really hot. And so if we tighten it down, we kind of stabilize. COVID was a recession unlike any recession ever. Not just in magnitude, it was just totally different. Durable goods went up Everybody wants to buy a car. Everybody wants to buy a TV, but buy a bunch of stuff that normally drives the recession. And what drove the recession is like nobody's going to the dentist. And like going to the dentist is not normally, that's a recession-proof sector. So all these services, which dominate what we spend money on in pre-COVID times, 65, 70% of consumer income and consumer spending goes to services, that thing goes down. And that led to a boom in manufacturing like we had never seen, accentuating the supply chain problems, because partly there was the business cycle and partly there was this transition of what people are buying. That is still unwinding. If you go look at the consumer spending, we're still spending well higher a fraction of our income on physical goods than we did before COVID. And I think it's still going back to the previous trend. That was the trend towards services is like an 80-year trend. So I think that's coming back. And so everybody just be a little careful concluding things about industry without being cognizant that there's still that weird thing lurking around.
Great, thank you. So this question I have to throw in there for my colleagues at College of DuPage and in higher education.
Yeah.
So I'm in meeting after meeting where people are questioning the value of a traditional higher ed degree. And I think, part of that's fair because the cost is increasing and higher ed can be slow to adapt. And while the Fed can't take a stand on a topic like this, as a longtime professor, as a parent, I'm wondering if you could talk a little bit about the role of higher education and or the impact of student debt on the economy.
Now, the Fed cannot the Fed is nonpartisan, take no policy position, doesn't endorse anybody's bill. But we can take a position on that, and we actually have researchers at Chicago Fed that have looked at the question. There's the public thing pushing back of people like, it doesn't even make sense to go to college anymore. The Fed research says that's absolutely, totally wrong. The college premium to not going to college has basically never been bigger. And if you look, I think it is the case that the average debt for a student that has debt when they graduate from college is over $20,000, which is not an insignificant amount of money. And the data shows that if you have a degree, you make something like $16,000 a year on average more for your entire life. So it's not for the typical person, it still absolutely makes sense to go to college. Now, you still got to choose a major, you still got to find a job, but especially College of DuPage, the average tuition paid for college is well below the sticker price, for going to Harvard or whatever they see. So I'm troubled by people convincing themselves too much that it doesn't make sense. I kind of want everybody to can we get them the Chicago Fed letter? We got to get them the Chicago Fed letter where it lays out the numbers. The thing that made the U.S. the richest economy in the world is, in our language, the human capital of the American workforce. And if we are, for many years, we had the highest share of 25-year-olds with a college degree in the whole world. We didn't become dumber. Everybody else saw that we had that, and we're like, that's how they did it. And so they've pushed to get their folks more education. And so now I saw some list, we've fallen down, maybe we're 25th or something, and we're between Costa Rica and Bulgaria. I don't have to tell you that if your education and human capital is somewhere between Costa Rica and Bulgaria, come back in 25 years, your income is going to be somewhere between Costa Rica and Bulgaria. And that's not an insult to either Costa Rica or Bulgaria, but it's just to say, I think investing in the human capital of our workforce is really important. doesn't have to be 4-year college. It doesn't have to be 2-year college. It could be the trades, but skills, ultimately skills equals productivity, and productivity equals how rich we are. So that's where my head is.
Great, thank you. At our business incubator in Innovation DuPage, I work quite a bit with regional startups and small businesses.
Yeah.
What role does the Federal Reserve play in fostering innovation and supporting emerging industries?
I would characterize mostly indirect role to provide a stable environment. Look, we got a very, is it a simple job? It's a straightforward job, but not a simple job. Straightforward job. Congress told us you maximize employment and stabilize the prices. That's what we do. That's important for an innovation community that is not. The more volatile things are, the less able small businesses and startups are to raise money. The more likely it is that stuff goes wrong and they failed. Though some of the bright spots, and actually I should have said it when you asked about what's optimistic. For 15 plus years pre-COVID, you'd seen a decline in, let's call it business dynamism in the United States. Increasing concentration of market after market, some through mergers, some by just the big getting bigger, and the number of new startups shrinking each year. With COVID, that totally reversed. We're in the new golden age of new business ventures and startups. And yes, some of it's AI and whatever, but a lot of it is just old-fashioned. People want to work for themselves. They want to try an idea, just the heart and soul and bread and butter of chambers of commerce around this country have been for decades. And that business dynamism is a great source of optimism. We're getting the signal that I'm speaking too long. I can be faster. The
signal is we have a few questions from the audience.
And we got some questions from the audience. Okay.
Thank you very much.
So I think the Fed plays a role to foster through when interest rates are lower, when real income growth is higher, when GDP growth is stable, all of those are the conditions that are conducive to starting new ventures.
Great. So, and this is certainly of interest to startups, but any size business.
Yeah.
What's the outlook on borrowing and access to capital for business in the year to come?
It depends greatly on what happens with inflation and employment from the Fed's perspective. In a way, that's the question: how tight are conditions going to be, credit conditions, over the course of this year? The Fed raised the rates really as fast as it has ever raised them, more than 500 basis points in a span of a little over 1 year. You saw that in surveys of credit conditions show up, and people start saying, whoa, geez, if this, and not just banks, not just Silicon Valley Bank, but just regular companies trying to borrow and do their thing. If we start getting the continued progress on inflation that allows us to kind of scale down the restrictiveness, then that'd be a fairly favorable condition for access to capital. If we don't, it'll probably still be tight, and it feels a bit like we've seen if not a bifurcation, at least different types of companies answering that question differently. If you're big enough to access capital markets or equity markets, they've been booming like crazy. And if you're more on the smaller side, where you're either going to banks or other kind of direct lenders, it's been a little tighter.
Okay. So you mentioned housing. It's come up quite a few times. It looks like we've got some real estate folks in the room. While rising interest rates typically mean a slowdown in the housing market, that really hasn't been the case here locally.
Right.
It's up 23 or 5% from last year. Is this a regional bubble? What can we expect in terms of rates and the impact on the housing market in 2024?
Okay, let's start with DuPage and Cook County. bubble. Don't say
use that
bubble. I
word.
thought you were going to say boom. Is it a regional boom? It's only a bubble if it's not based on fundamentals. If you look at DuPage County, like you said, the unemployment rate is below the national unemployment rate. Income growth has been relatively strong. It's been one of the brighter spots, and the Midwest has had a tough COVID times.
Education
for
rate
sure.
very high as well.
And the education rate is very high. So in a way, I'm not surprised to see that kind of strength. The broader national question of isn't housing interest rate sensitive, and interest rates went way up, so why isn't housing going down? That's a little complicated in the short run by how fast the rates went up, because it affected the supply of existing housing in a negative way. At the same time it raises the cost of having a mortgage. It also convinces you, if I have a 4% mortgage, I don't want to sell my house if I don't have to, because I will have to take an 8% mortgage. So you saw that kind of suppression of supply, and that holds up prices, and those higher prices kind of incentivize construction. That's only a short-run phenomenon if you think about it. Eventually, if you get transferred, you got to move. Like, this is what it is. So that's rates to housing has proved a little more subtle or a little more complicated than kind of the stereotype, but I still think the basic dynamic, if it stays as restrictive, if rates stay as restrictive as they are now, in the end, that's going to be tough on housing, because housing is an interest rate sensitive sector.
Okay. I want to end with what I hope will be a fun question, but one more here about the Fed's. Is the Fed concerned about household debt and business debt loads?
Always, and so yes. It's worth noting that what people call the excess savings, actually there was less debt than, by far less debt than normally exist across a business cycle. Normally, you go into recession, there's a big increase in debt for the bottom half of the income distribution. It's a tough environment. Right. In this case, through stimulus, through whatever, the balance sheet improved quite a lot, and that made the impact of monetary policy in some sense a little blunter, because if people aren't borrowing money and the interest rate goes up, maybe they don't care. So as we've gone through the stock of pent-up savings, that's made it so that you see the change in debt going up. And a lot of people look at how fast debt is rising. But the other way to look at it is it was really low, and it's rising now to something like what's normal. So I kind of think, like with delinquencies I mentioned at the beginning, it's again, historically, when that thing was rising, it's a cautionary indicator, but it's rising from what was a super low level, so maybe it's not an indicator. We're just going to have to see.
Okay, great, thank you. So I've heard you talk about your transition from being a professor to the White House.
Yeah.
What about this transition into the Fed, and any surprises in your first year of this job, or year plus?
Yeah, right. In the Fed is like reverse dog years. So like you be there 7 years and they're like, I'm a rookie. That's kind of how the mentality. There's a very powerful culture at the Fed, which is lovely. They believe in the mission, and the Chicago Fed, I shouldn't say this out loud, but I always say, look, we have all the competence and excellence of the New York Fed, but without the attitude. That's kind of our thing. And I say, it's the Midwest. As you know, the Midwest motto is, there is no bad weather, there is only bad clothing, and like we deal with the conditions whatever they are, and that's the Chicago Fed mindset. Now that said, the economic part in the FOMC wasn't a surprise. I mean, it's really cool. If you're like an econ gym rat, the FOMC is just as cool as you would want it to be. You know, there's a huge table and the shades come down so that no one can spy on you. And they go around and they're like, what do you think about the economy? The surprise was the Chicago Fed, the operational side to the bank. There's almost 2,000 employees. And one of the things that the Fed does is provide financial services to its member banks, which includes cash for their ATMs, or if they have cash and they want to send it in. So the Chicago Fed has a giant vault with a door that's literally this thick, and the door weighs 40 tons, that has $25 billion of cash in there, and we have Brinks trucks in and out all day, and high-speed machines that catch the counterfeit. I'm fascinated and love this cash operation. And they have tours, and I alone was almost 1/3 of the tours of cash. I brought my mom there. I brought the kids, all my friends. So it's really been it's been exciting. It's been fun.
Well, it's really been a pleasure getting to know you a little bit, talking to you. It's a great honor to have you come out and share your wisdom with us. I think I'm going to turn it back to our host, but thank you so much, Dr. Goolsby.
Thank you.